Welcome to the first educational video in our series. As we mentioned in the intro, these early videos are going to be focused on building a foundation. To kick things off, in this video, we're going to differentiate the primary mortgage market from the secondary mortgage market, provide some insights into the role of secondary or capital markets departments, as well as define day one margin and interest rate risk. So let's get started. Simply put, the primary mortgage market is where borrowers and loan officers directly interact to originate a loan. If the loan is approved, the lender provides funds to the borrower so they can purchase a home or refinance an existing mortgage. The closed loans can either stay with the lender or they can be sold into the secondary market. Lenders who keep loans in portfolio will receive a long-term cash flow from the borrower's monthly principal and interest payments, as long as the loan stays on the books. The secondary mortgage market is where closed loans and their components are traded. Most closed loans entering the secondary market are pulled together into mortgage-backed securities, which are fixed income investments that can be purchased by investors all over the world. Mortgage-backed securities are essential to bringing liquidity to the U.S. housing market, and they're often a key element behind questions we'll be tackling throughout this series, especially those around rates, pricing, hedging, market color, and more. For this reason, we're going to cover MBS in much more detail over the course of several videos. Lenders who sell loans into the secondary market will typically receive an upfront premium at the time of sale in exchange for giving up the right to collect the monthly principal and interest payments from the borrowers over the life of their loans. This provides lenders with an immediate influx of cash, freeing up capital and borrowing power so the lender can continue to originate more loans. Additionally, the secondary market involves a lot of participants, including mortgage lenders, agencies, aggregators, broker-dealers, and investors. Many lenders will have many relationships or counterparties in the secondary market that need to be managed and fostered. We'll be talking about these counterparties separately in an upcoming video. The loan process, encompassing everything from initial application to closing, primarily occurs within the realm of the primary mortgage market. However, it's important to note that elements of the secondary market are woven throughout the origination process, so the secondary team will be involved with the loan in some capacity from origination to closing and even after as the loan enters servicing. For example, many of the initial rates and pricing offered to consumers are derived from the secondary market. Similarly, many products and programs a lender offers are based on the secondary market, and most underwriting guidelines come from agencies and aggregators in the secondary market. The management of locks and hedging a lock pipeline throughout the loan process is also based on the secondary market, and the list goes on. The point is, the influence of the secondary market is evident in a lot of aspects of the loan process, which underscores the significance of the secondary market in modern mortgage lending. Because the primary and secondary markets are intimately intertwined, the secondary marketing department will be working with parties from both the primary and secondary markets on behalf of their lender, and they'll be involved throughout every phase of the mortgage process. Before we move on, I want to take a minute to address mortgage secondary versus mortgage capital markets, because as we go through this series, I will often be using one or the other for the sake of brevity. While there are some technical nuances between mortgage secondary and capital markets, in the mortgage industry, they're often used synonymously, so spending much time differentiating between the two won't provide much value or insight. One organization may have a capital markets department, while an almost identical organization may have a secondary marketing department. Which designation they use is usually just based on the organization's preference. One last note here, loan officers and sales teams are very familiar with the lock desk role within an organization, especially since lock desk primary responsibilities are very loan officer facing. Since the purpose of this series is to bring behind the curtain, most of our videos will be geared towards some of the less obvious but essential responsibilities of a secondary team. Additionally, secondary's role can vary greatly depending on the type of financial institution, as well as some of the following characteristics, such as if the lender has an internally hedged pipeline or not, factors such as the lender's overall business model, as well as available channels like wholesale or correspondent, whether or not they have a servicing portfolio, if they securitize, if they have an in-house portfolio, and if they're responsible for capital structures or creating loan participations, and more. There are also certain areas of overlap in an organization where responsibilities may be primarily handled by the finance department at one organization, but the secondary capital markets department at another. Similarly, secondary may be responsible for overseeing post-closing and or servicing, and they could be heavily involved with reporting and other metrics as well. But while there are a lot of different ways the responsibilities of secondary can vary, in my opinion, there's one clear differentiating factor that has the biggest impact on secondary's chief responsibilities, and that's whether or not they have an internally hedged pipeline. For lenders who lock and sell 100% of their loans' best efforts to their investors, the most critical responsibility of secondary will be to manage lock desk activities, manage relationships with the best efforts investors, and maintain margins on best efforts locks. For lenders who internally hedge their locks, secondary's most critical responsibility to the organization are to capture and maintain the company's target margins and to appropriately manage interest rate risk so the lender can continue doing business and remain competitive. The focus of this video series will be geared towards lenders who are internally hedging their locked pipeline, which covers the vast majority of lenders. So before we move forward with the series, I want to start introducing the concepts of day one margin, interest rate risk, and hedging here since they'll be coming up regularly throughout the series. While we'll be giving them a brief introduction here, we'll be covering them in much greater detail as we advance through the series. Lenders who hedge and sell closed loans into the secondary market will build an anticipated margin into the rate sheet in the form of premium pricing meant to cover production costs and meet profit objectives. At the time of lock, this day one margin is the projected revenue the lender is expecting to receive once a loan is closed and purchased in the secondary market. For example, on a $300,000 loan amount, the lender may have 3 points of margin built in, which equates to an expected $9,000 gross revenue before adjusting for pull-through, which is the probability of the loan closing. In addition to the cost to produce and target profit margins, the day one margin will need to cover any LO and branch compensation and any risk-related adjustments that may exist due to credit or interest rate risk. Regardless of if the loan is locked best efforts with an investor or internally into the hedge, once this day one margin is set, there are virtually little to no scenarios where this margin can increase, even when the market is improving. However, there are a number of ways the margin can be chipped away at. These include waived extension fees, renegotiations, honoring misquotes to borrowers, bad data, underwriting, operational or disclosure errors, hedge-related transaction costs, or modeling failures, just to name a few. And in some cases, this target margin can be eroded completely if not managed properly. For this reason, secondary will be tasked with preserving as much day one margin as possible while working closely with their sales teams to maintain their customers and keep winning deals. In addition to errors and market-related margin reductions, price concessions and rate matches can further impact these day one margins. For example, if the target margin was 3 points on a loan, but the loan officer had to offer a half-point price concession to win the deal, the day one margin will be reduced to 2.5 on that loan. For this reason, secondary will be responsible for reporting on and monitoring each category of margin reductions, as this plays an integral role in the overall pricing policy. Some of these reductions to margins are largely avoidable by putting appropriate controls in place, but other reductions of margin may be considered part of the cost of doing business and retaining deals in the face of changing markets. For example, offering a renegotiation to a customer who would otherwise leave for a better rate elsewhere. Additionally, throughout this series, we'll often be referring to excessive margin reduction or excessive concessions. This refers to reductions beyond what is needed to win or retain a borrower. For example, the lender giving a half-point concession when the customer would have stayed for a quarter, or proactively renegotiating locks in a pipeline that haven't been specifically requested by the customer. Reductions to margin are a common source of missed revenue for a company, especially if certain margin losses aren't being offset with an appropriate hedge strategy. It's extremely important to note that not all hedge models can appropriately account for margin reductions, such as renegotiations and the drop in MSR values. And even when they can, it's still much less risky for organizations to limit and control excessive margin reductions than to rely entirely on the hedge. As a final note about margins and profitability, I do want to make clear that in this video series, we're primarily going to be focusing on lender premium and secondary spreads, which directly relate to secondary market activities. While origination and application fees do contribute to a lender's margin, and waiving these fees does affect overall profitability, since these fees aren't directly related to secondary, we won't be covering them much in this series. Interest rate risk refers to the potential impact that changes in prevailing interest rates will have on the value of a locked pipeline. If prevailing interest rates go up, the value of the locked pipeline tends to decrease, and vice versa. To protect against this risk, all locks are hedged. Even if the lender locks all their loans' best efforts, these loans are still hedged. The only difference is the investor takes on the responsibility and passes the cost of hedging through to the lender in their rate sheets. For this reason, best efforts are often referred to as externally hedged or investor hedged locks. When lenders make the decision to handle the interest rate risk internally, it has major implications to the organization. If locks aren't managed and hedged correctly, the lender could sustain significant financial losses. This could be the tune of tens of thousands to tens of millions of dollars, depending on the size of the lender's pipeline and the severity of the market environment. This is why understanding, proactively addressing, and continually managing anything that poses interest rate risk to the organization is one of the top priorities for secondary. Interest rate risk is primarily addressed by accurately hedging the locked pipeline and creating policy and procedures that aim to mitigate risk. While we'll dedicate videos to really diving deeper into interest rate risk and hedging, there are a couple things I want to keep in the back of your mind about hedging at all times, because it'll really help explain why secondary teams responsible for managing this interest rate risk are so actively involved as soon as the lock comes in. 1. As we mentioned before, every lock is hedged to protect against changes in prevailing interest rates, and every lock presents a variable amount of risk to the organization. 2. There are initial and recurring costs associated with hedging. Hedge positions are adjusted daily, and sometimes multiple times a day in extremely volatile markets, and each hedge transaction has costs. The longer a lock is hedged, the more hedge costs it accumulates. Furthermore, if a loan doesn't close, there's no ability to recover those hedge costs. 3. To be able to hedge a position accurately, analytical models need to accurately predict how the value of the lock pipeline will react to changes in interest rates, how many of the locks in the pipeline will ultimately close or pull through, and for the ones that do close, how much of the day one margin will be preserved. The model's output often dictates how the lender adjusts their hedge position. If the model is off and it leads to a lender's position being hedged incorrectly, it can lead to substantial financial losses to the lender. Typically, this occurs if inaccurate or stale data is passed through to the model, reductions in margins aren't accounted for, or if the model itself isn't effective and hasn't been appropriately optimized. And 4, passing the hedging responsibility onto a best efforts partner by locking all loans' best efforts just results in the best efforts investor building these costs of hedging into the lender's best efforts rate sheet pricing. This can lead to significantly reduced revenue opportunity to the lender and worsen pricing offered to loan officers. So why does all this matter to sales teams? Remember, if a lender isn't profitable in secondary due to hedge losses or missed revenue targets, they'll often need to build margin into their rate sheets to try to return to profitability on new production. This is why appropriately managed interest rate risk is so important to everyone in the organization, as it will help ensure the lender meets their revenue and profitability targets and keep the pricing offered to loan officers and their customers consistent and competitive. In this video, we spent some time establishing some baseline definitions and concepts that we'll be referring to frequently throughout this series, especially interest rate risk, margin management, and hedging, all of which we'll describe in much greater detail in upcoming videos. Before we really dive into the secondary market though, we're going to spend the next video talking through some of the things secondary is doing behind the curtain and viewing the mortgage process through the lens of the secondary team. We hope this helps provide an understanding of the actions being taken behind the scenes to protect your company from interest rate risk, managing margins, and keeping the company profitable and your rate sheets competitive. Thank you for joining us, and we hope to see you at the next video.